Welcome back to Chapter 4, Assets, Liabilities, and Equity. During this PowerPoint, you will be directed to reference the fundamental accounting equation that you can find in the Files tab of our class module. There are two ways that this equation can be expressed. Assets equals liabilities plus equity, or you can take the assets and subtract liabilities to get equity. Please pause the PowerPoint on this slide to try a sample transaction using the accounting equation. Take a moment to read the three sentences. Now, using the two accounts shown, the increase or decrease in the equipment account and the increase or decrease in the accounts payable account, and then go on to the next slide. Since equipment is an asset, you would increase the asset account, and since the accounts payable account is a liability, then you would also be increasing the amount of the liability account with the amount of the purchase, $1,000. The balance sheet is a financial statement that represents the fundamental accounting equation. It is a look at the business at a specific point in time, typically the day the fiscal year ends or when the financial statements are being prepared. The three account types on a balance sheet are assets, liabilities, and equity. These balances carry over from year to year. So the ending balance of one year becomes the beginning balance for the next year. How do you record an asset purchased with cash? Think about our Sherry's laundry example when she purchased a washing machine and she used accounts payable. Let's go ahead and use that same example, but assume she used cash. You would debit the asset account equipment to increase equipment, and then you would credit the cash account, which is also an asset, but that would have the effect of decreasing cash, and your accounting equation would remain in balance. Assets can be classified as current or long-term. Current simply means that they are items on the balance sheet that can be converted into cash within 1 year. Of course, cash is already cash, so that would be considered the most liquid, in other words, the most easily converted into cash, say a checking account. Long-term items are those that are expected to be converted into cash in more than a year. See the examples below. Assets can be classified as current or long-term. Sometimes they are presented on a balance sheet by these classifications. We saw that there are different types of assets: cash, accounts receivable, etc. There's also the fixed assets, which are long-term assets. They are physical items that the business does not intend to sell. It would not be considered inventory that the business would sell. They would be items that help to produce income or are used for the purpose of business. Just because these items are used in the business for a long time, it doesn't mean that they retain their initial value when they're purchased. So the business has to find a way to show that these assets are getting used up or expensed over time. Accountants use depreciation as a way to record the use of assets over time. Liabilities are things or amounts that an entity owes that are due to others. Here are some examples. In the financial records, you also need to record liabilities. So if a company like Sherry's Laundry purchases equipment on an account, like accounts payable or a credit card, then liabilities will increase. The way to increase a liability is to credit it. The way to decrease is a debit. Just like assets, liabilities can be classified as current or long-term. Students can find the equity section of the balance sheet a bit more complex than the assets or liabilities. You may want to refer to the fundamental accounting equation and see that it is an umbrella to a few different accounts such as stock, revenues, expenses, and dividends. Essentially, the equity section of the balance sheet shows how much of the company that you actually own that is not owed to someone else. Entities are organized or structured in different ways. For example, a company can be owned by one person. That would be a sole proprietorship. Two or more people could own partnerships or possibly limited liability companies. And then there are corporations. Depending on the type of business entity, the equity section of the balance sheet will look different. Other kinds of entity structures are governments, such as tribal governments, and within that, tribal nations, and local governments, such as districts. There are other organizational types, such as nonprofit organizations as well. Each of these entity structures and equity section will look different depending if it is a for-profit or not-for-profit organization.